Well, balance of payments tracks transactions between a country and its trading partners in the rest of the world, okay? So if you think of a balance sheet showing me assets and liabilities for a company, well, balance of payments is more macro concept at the country level that's showing me what's happening between my country and the rest of the world. And this can be then further split into two accounts. One is called current account. The other one's called capital or financial account. Well, the current account looks at goods, services, investment income, unilateral transfers. Okay, so goods and services, this is just exporting and importing of those goods and services. Investment income, so if I've made investments abroad, I bought houses abroad and getting maybe a rental income, that's coming back to me because I reside in my country. Unilateral transfers will be typically gifts. So if I go and work abroad and then send money back home to my family, that's a unilateral transfer. All of these things are going to fall under the current account. Now, you need to be comfortable with two words. Surplus roughly means that my exports exceed my imports. So I've got a positive net export. I'm exporting more to foreigners than importing from foreigners. Yeah, so that's giving me a surplus in the current account. And a deficit would be the opposite. I would be importing from the foreigners more than I am exporting to them. So that is the current account definition. Now, the capital financial account, that's going to be looking at, for example, purchases of debt and equity. So if I'm purchasing debt and equity of foreigners, so the money is leaving my country, I have a capital account deficit. On the other hand, if foreigners are purchasing my debt and equity, money is coming into my country, I'm going to have a capital account surplus. And so here, the main question that you need to understand is how these two things might be related. And I've got a little bullet here, a little possible example. I might have a current account deficit. And here, I really want to take the example of the US, because the US has this exact situation. The US has been running a current account deficit for many, many decades. And as we said, a deficit simply means that imports are greater than exports. And we all know the US is importing more than they are exporting. So that's giving it the current account deficit. Now, what does that mean? It means that the money they collect from shipping their goods abroad is less than the money they spend abroad. Okay, so they basically spend abroad more than they collect. If you think about a household analogy, it's the same thing as me spending more than my monthly income. Let's say I make 1,000, but I spend 1,500. I've got a deficit, right? 1,000 is coming in, 1,500 is coming out. I've got a deficit, monthly deficit. And of course, if you're a person, you'd know immediately that the only way you're going to sort that out is by borrowing that deficit. Yeah. So if I I suppose you could have savings and you're running down your savings, but let's say you don't have savings, you'll have to borrow that deficit, that $500. And that is where the capital account comes in, my friends, right? So if I'm running a current account deficit, I must be borrowing from the foreigners, or the foreigners must be lending to me. And how are they going to do that? Well, they're going to do that by buying my debt and my equity. So, for example, think about the counterpart, which could be China. So the US is running the current account deficit vis-a-vis China. China is running the current account surplus. So China's getting a lot of dollars because it's selling a lot of its goods to America. Now, what is China going to do with these dollars? Well, China's going to take those dollars, going to go back to America. It's going to buy US Treasury bills. It's going to buy stocks. It might buy real estate and so on. So from the point of view of America, those dollars are going to flow back into the country, giving America a capital account surplus. So the point we're making with this last bullet is that often you will see that the country has a current account deficit because it's importing more than it's exporting, and that is then counterbalanced by a capital account surplus because foreigners are lending to that country. And from the point of view of China, it would be the opposite way. They might be running a current account surplus because they're exporting to the world more than what they're importing, but then they end up with these dollars that they have to invest abroad, so they have a capital account deficit.